Hello, everyone. I hope you've joined, and it's going to be one interesting session, I would imagine, in the next 1 hour as we speak. For all of you who just joined, it'll be very interesting because it is something I suspect a lot of you may not have heard of. Uh, well, if some of you have heard of the detailing may have been missing, maybe. So over the next 1 hour or so, as we begin in the next couple of minutes, we'll be talking about a very interesting opportunity to invest in the US markets. Now, it's not so simple, you would think, to invest in the markets as far away as the US because, a different jurisdiction, different country, different markets, different dynamics. But it could be as simple as investing in the Indian markets. And hopefully, for all of you, more rewarding as well. So, so imagine a market which has the depth. The market is several times the size of India. India's offhand, I don't remember, but it should be a little over $1 trillion in market cap, or maybe a little bit more than that, India. But US should be many times of that. That market has a lot of depth, different kinds of themes, and that's what we'll be talking about in the next 1 hour or so. And very important, we want you to take away a lot of stuff. So we'd want you to ask questions. We'll take as many questions as possible. And once you have your questions answered, hopefully it'll apply to everyone. So we'll have the expert joining. And when your question is answered, if there's anything more, just let us know as well. So too many interesting things happening and too many. I see quite a few participants have already joined. So let me formally begin. Good evening, everyone. And it's a Friday evening. So normally it's time to relax, but it's very serious stuff. But we hope to make it fun for you as well. My name is Ashutosh Sinha, and I'll be the host for you for today evening. And of course, if you can help me by just being a little orderly, just following some of the basic things that I'll mention, it'll really help me do my job well and earn probably a pat in the back from you as well. So let me explain this first. This is an educational initiative, and we'd like you people to know that there are opportunities in the markets, in the stock markets that is, that may not be visible to you, that may not be very apparent to you. I personally have tracked the stock markets and the economy, Indian economy, for a little over 20 years, learned a few things over those 20 years. But in all these years, I probably can't recall even once when somebody has told me that they would like to invest in the overseas markets. It's been permitted for the last few years in India, but I don't know of any investor who has mentioned this to me. So we wanted to use this opportunity to explain and educate the people about the opportunities and ideas for this long-term investing. And the reason why I'm explaining this is it's very important because you'll have to be very patient with this. The next minute or two will introduce the guest as well, the expert as well. So we hope that our effort can serve as, for you, the viewer, as the germ of an idea for investing in the US markets. And there is no better, it's been proven worldwide many times over that there's no better asset class than equities. And that's why not try the biggest equity markets that there is? But for the moment, let me step back and tell you what all some of the house rules so that you can follow that to make sure that everything can go smoothly. If the audio for us goes off while we're talking, just raise your hands. There is an option there on your screen so that we all will get to know. If you can use the Q&A box to ask your question, we'll try and take as many questions as possible. That'd be wonderful. And please note that some of these questions may be repetition, so we'll try and take a different question each time. And if there are any unanswered questions, and we're hoping there might be just some, we'll make sure that we answer those questions after this is over, and we'll get in touch with you, and your question is answered. Okay, so let me introduce the expert today. Kumar Subramanyam from Stockal joins us, and he will answer some of your questions. Good evening, Kumar, and let me give a very brief introduction of Kumar's very illustrious career that he's had in the last, 2 decades or so. So Kumar has been part of a venture capital firm focused on early stage investing with asset under management in excess of $1 billion. He's run a proprietary trading business to invest in the equity and derivatives in the US markets, and now helping Stockal helping people invest in the US markets. That's quite a bit, Kumar. Thank you so much for joining us, and welcome to this very important event.
Thanks, Ashutosh. Very kind words. Very nice.
Thank you. So if you could help set the context, why is today such an opportunity, such a wonderful opportunity for Indians to invest in the biggest equity markets in the world and perhaps ride that wave that we are seeing right now?
Right. Yeah, I think that would pretty much set the tone for what we are going to discuss in terms of the wealth creation opportunities today that exist through the global markets. What I see why today more than any time prior to this in history is the right time to invest in US opportunities, because there are 2 or 3 large supply side and demand side themes that are converging. And that is making the opportunity very exciting today. I'll talk about some of these supply side themes. I will talk about some of these demand side themes. We'll have a discussion around that. And the convergence of these themes is what is leading to what we believe is the LNG of growth, or the liquidity, the new ideas, and the global scale of businesses, so to speak. The LNG of growth that's fueling investments in global markets. So I spoke about demand side themes. I spoke about supply side themes. Let me talk about demand side first, which is Indian investors. If you look at it, right, there are 2 things that have happened in the last 4 or 5 years that's driving this theme. One is in around 2014 is when the RBI, through its liberalized remittance scheme, allowed Indian residents to start investing in global markets. RBI had various limits at various points in time in the previous 2 decades, but in 2014, a major bump up to that limit to make it $250,000 for every Indian resident individual. And since this has happened, what we've seen is a 10x jump in the amount of investments that Indians have made globally. About 5 years back, these remittances amounted to about $2 billion, and just last financial year, they amounted to about $20 billion. So we've seen a 10x jump in the last 5 years. That's been a big demand side trend that's been there. The other trend, if you look at it, is just in terms of the way Indians have started thinking about investments, right? If you go a generation back, probably, they largely thought about investments as investing in real estate, investing in fixed deposits, and the theme was largely local. About half a generation back, if you look at it, that theme expanded to become more national when there were these national stock exchanges that were set up. People started investing in equities, people started in mutual funds. Now we see that with this generation in the coming next 5 to 10 years, this theme is going to go global. And that is why today, more than any time before, is a great opportunity for Indian investors from a demand side perspective. From a supply side, if I look at it, and I'll take a couple of minutes to explain this in a little bit of more detail because it sort of sets the platform for our further discussions. On the supply side, if you look at it, US markets have outperformed all global markets, including Indian markets, in the last 1 year, 3 year, 5 year, 7 year, 10 year. You pick any period, it clearly outperformed the public markets. And one of the reasons for that has been these new ideas that we talk about, right? The innovation cycle, the way innovation gets funded in the US, the way retail investors are able to participate in some of these innovative companies is all very transparent, is all very robust as a mechanism. And that has led to a boom in the equity markets in the US. Even in terms of the amount of time it takes a company to go public is very short in the US. It's about, on an average, anywhere between 5 to 7 years from inception it takes to go public. And what happens is, as a retail investor, then you get to participate in this growth story. So in terms of the new ideas that are coming to the market. And the third big theme that I talk about is global scale of businesses. Today, for example, compare it with, let's say, 10 years back, 15 years back. Today, if you look at brands like Apple, like Google, like Facebook, Netflix, all these brands, right? We're all consumers of this, which means that globally we've all become consumers of these brands, hence are aware of what these brands bring to the table and want to participate in the growth stories of these brands. So, and today there is an opportunity to do so. So, given these demand side parameters that are playing out, given the supply side themes that are playing out, I believe today more than any other time is a great opportunity to invest in US markets. And what is facilitating this is the availability of technology platforms where it becomes very easy and very seamless for an individual investor to be able to start investing in the US public markets.
So it's very interesting that you mentioned that a lot of us consume some of those Netflix, the Facebook, and some of those, and also some others. There are some other also themes which are playing. You raised the issue of themes, renewable power, for example. I was just reading yesterday or day before that for the first time since the 19th century, uh, renewable power has overtaken coal in the US. Now, this is the biggest market we're talking about. This is a growth opportunity that investors need to be part of. They probably can share the wealth that is created, right?
Absolutely. And there have been themes, there have been emerging themes that you spoke about, like renewable energy. There have been themes which have played out even in the last 50 to 100 years, which still remain robust. Things like banking, things like retail, right? Obviously,
Mm.
in terms of technology coming into all of these business verticals, it's taken a different dimension. But there have been these robust themes that have been there all along, where retail investors have been able to participate in these themes through public
Mm.
markets.
Mm. Okay, here's what I'll do, Kumar, because there are quite a few questions also pouring in. So I will also, as we go along, as we talk, I'll also want to take some of those questions that are coming in. So with your permission, should I go ahead with the first question?
Sure, sure, absolutely. I think we should blend it in terms of what the the sort of education that you spoke about and answer some questions which are very common.
Sure. So Sneh Kumar Sharma has a question, and he's, my God, I mean, right in the beginning, he's fired his question. It says, is it worthwhile to invest in US stock when a number of internationally acclaimed economists are predicting that the US economy will enter a recession in next 6 to 8 months, as present upswing in markets is only due to surplus liquidity pumped by the Fed? Uh, just to put the context, I mean, we were just showing a little graphic on screen on the kind of liquidity that the Fed has pumped in the in in that period, that 2009 to 2014 period, and that has led to the 10-year boom in the markets. We are again seeing from that recent 23rd March low, Dow is up more than 40%, so is the S&P 500. Uh, Liquidity, everyone bows before liquidity, so do the share markets.
Absolutely, you're bang on there. I think, see, you look at the data points suggesting from the 2008 financial crisis when the US Fed started the quantitative easing programs, they started pumping in equity into the markets. That was a big support mechanism that was put there in the for US equity markets. And I think most global markets followed that trend. Some of the largest markets in Europe followed the same trend of quantitative easing. Now, like you mentioned, Fed has put together a structure even for the price correction that we've seen in the last 3 months due to the impact of the virus spreading globally. The point is very simple. I think if you look at it from a timing perspective, there is always going to be a question saying that, am I getting in at a peak? Am I getting in at a trough? Am I getting in somewhere in between? The fundamental story is you have to believe in equities. You have to believe that equities are going to be the big growth engine, and you have to identify opportunities within this. So, is today, like I was having a discussion with a customer just yesterday, and he said, "Hey, it looks like I missed the bus because I knew when Apple was at $100, I didn't buy it. At $300, should I be buying it?" Well, the point is that sure, you're going to get one stock instead of three today. In terms of if you look at it as if you miss the bus, but then look at the business and growth opportunity that a brand like Apple has, even in terms of end consumer markets like India, other Asian markets, European markets, and things like that. That is where the growth story is going to come from. And the
Mm.
US market is going to offer you this opportunity. So there are two ways to look at it. One is to look at the overall macro picture, the market, and say, what are the trends? When do I get in? Second is to also look at some of these interesting investment opportunities, whether they are in biotech, whether they are in pharma, whether they are in technology, saying that these are global themes that are playing out. And US remains the hub for all of these innovations. So for you to participate in that growth story through public market equities, US is the place to be.
Mm-hmm. Also, there are some questions coming in, which of course we'll talk about is what is the minimum and maximum that Indians can invest in the US? It's about regulation. It's about the financial regulation. But if you could spell that out for people.
Correct. So in terms of the maximum, RBI has spelled it out for us. It is per Indian individual, you are allowed to invest $250,000 every financial year in global markets. Of course, this comes through RBI's LRS scheme. So the cumulative spend under the LRS scheme can be $250,000, and there are various reasons for which you can remit this funds. It can be for travel, it can be for education, it can be for portfolio investments in equity and debt instruments, what we are talking about. But overall, it's a very strong use case for Indians to start building a global portfolio, because a lot of customers, for example, right, whom we've been talking to, who let's say have a travel or an education expense that's going to come up 2 years, 3 years down the line. Now is the right time to start building a global portfolio around that expense, saying that, I'm going to set aside so much funds. I'm going to expect this growth rate, and hence this is going to fund my travel or education expense 2 years, 3 years down the line. So that's in terms of the maximum. In terms of the minimum, I think one of the consistent questions that we keep getting is, do I really need to be an HNI to be investing in global markets? Well, turns out not. You can invest with as low as $1,000. When people talk about constraints, saying that, how much cash do I need to invest, they typically talk about two constraints. One is the time and the effort constraint. It's just so cumbersome to set up an account, to do the fund remittance. The second is the capital constraint, saying that, do I need to have deep pockets to be investing in global markets? I think the technology platforms that I spoke about earlier, they're bridging both these gaps. So today, in terms of setting up a digital account to start investing in global markets, it's going to take you no more than 15 minutes. Today, to start remitting your funds from your Indian savings account to this investing account that you're set up, it's going to take you 1 to 2 working days. And there you go. You're all set to invest in over 4,000 stocks and ETFs that are available in these global markets. In terms of capital constraints, we'll talk about a concept called fractional shares that is very prevalent.
In fact, very interesting point that you've made, because there are a few questions coming in about fractional investing. Right. If you can explain, I mean, a typical Google stock is over $1,000. Amazon is like 2,000 plus. Yeah. So that is like 1.5 lakh rupees. How does an Indian invest? What is this idea of fractional investing?
Right. And I'll tell you where the concept of fractional investing came from. It's very relevant for a mature market like US, because typically you look at a US market, over 50% of the households in US participate in their public markets, which means that retail investors are huge participants in their public markets. So there are always these concepts, financial concepts, that keep coming to facilitate a retail investor to invest. Compare that with India, less than 5% of Indian households participate in equity markets in India itself. So given that, there are a lot of mechanisms in the US market that facilitate this participation, and fractional stocks is one of them, which means that, let's say I have only $1,000 in my pocket. Does that mean that I should just pick a single Google stock, which means place a very linear bet and sit tight and hope that Google does well? Or can I build a diversified portfolio with just $1,000 in my pocket? The answer to that is the latter. With fractional stocks, you can choose to buy 0.001% of Google, 0.02% of Facebook, and hence build a reasonable sized portfolio, even if you have a budget of, let's say, anywhere between $1,000 to 5,000. And I'm just picking 1,000 and 5,000 as some benchmark numbers. Correct. In terms of anything more than $100, you're given an entry pass into the public markets in US, so to speak. And there you go. That's what sets you up for investing.
So that's not very difficult as well. So that's the fractional part of it. There are other. So some people also want to understand the tax implications. Would you just very briefly touch upon the tax implications? I know it's slightly separate, but it's one small part. So if you can just refer to it very briefly, please.
Absolutely. So like you rightly said, tax related information is typically very personalized because it depends on the context of the individual, whether he's an Indian resident, whether he's non-resident citizenship, and multiple other such factors. But at a very high level, between India and US, there is a double tax avoidance agreement. So one thing that is very clear for an investor is you're not going to get taxed at two places. You're going to get taxed only at one of the places. Now, which of these two places is it going to be depends on the type of income that you're earning. So let me talk about two very high level incomes instead of getting too deep onto that. In terms of your dividend income, there is a tax deduction of source that happens in the US, and the US tax authority, which is the IRS, give you an acknowledgement of that when they deduct taxes at source. In terms of your capital gains, you're not taxed in US at all. You file it along with your tax returns here in India, and any of your, it's a very simple form. Your chartered accountant who typically helps you with your tax filing in India would be more than happy to do that. But the main thing to remember is that you're never taxed twice just because you're investing in the US. It is always in one of the two places, either in US or in India, and you can offset the tax liability.
You also spoke in detail about the LRS scheme which allows the Indians to do that. Can you also explain a little bit on the themes that play out? It's very important to understand that. And, the reason why I asked this is also from an investor's point of view. Facebook IPO happened at the beginning of the decade, if I remember correctly, 2012 or 12 or 11. Similarly, Alibaba came some years ago. Again, these are very big names. These became household names. Everyone uses that. How does the investor identify some of these opportunities that are going to be playing out?
Absolutely. So and the question that you're asking is relevant for any public market again. It is not just about US markets. Like if I were to begin investing in, say, even in the Indian markets, beyond the point, my question, obviously the top 10, 15 brands, for example, some of the names you mentioned, Amazon, Apple, Google, is somewhat familiar with the business model, which means we understand what the company does, how does it make its revenues. But then how do you go beyond these top 15, 20 stocks, for example, right? US public markets are fairly big, 5,000 listed stocks out there. So how do I pick and choose these opportunities if I were to replace? Well, there are two ways to do about it. If you're a trained financial professional, if you have experience of investing in other markets, then you apply the same investing principles, whichever global market you go to. You get to, if you're a value-driven investor, you understand the fundamentals of the business, you understand if there is enough value in investing in this. That's a very simple approach. If, let us say, you're more driven by advice as an investor, then the technology platforms that I spoke about, right? A lot of these technology platforms also offer curated portfolios for investors to start investing in. So just like in Indian markets, there are a lot of financial advisors, there are a lot of financial planners, there are a lot of fund managers that are available in the US. And they present to you typically in the form of a curated portfolio depending on your risk profile. So it's very important to understand as an individual investor that what works for X may not work for Y because you're in a different phase, your goals with investing are very different. So it's important to understand what your risk appetite is and what will suit that. Now, equity as an asset class, we all understand is slightly more risky than, let's say, a fixed deposit. So keeping that context in mind, it's very important to not necessarily always go stock picking, but to build a curated portfolio that suits your risk.
There are also a very interesting question coming, and you have all kinds of investors, all kinds of people in the market. So Sangameshwar Kendre is asking, can we day trade in the US markets? Please give us details of the same. Now, this is a little specific, very specific given the context in which we are talking, but this is important. Some people would like to day trade. Is that possible?
Yeah. And anyone who studied the US market will tell you that US markets have been supportive of traders for longer than any other market, for example. So if you look at traders versus investors typically in a conversation, right? In fact, US markets were the hub for most of the high frequency trading platforms that got built. So US markets allow for day trading. Now the constraint is more on the supply side, like I said. So RBI under its LRS scheme very clearly specifies that when you're making a portfolio investment in equity or debt, you're not allowed to do any sort of speculative investment. That is the mandate as of today, which means that you have a regulatory constraint on one side saying that you're not allowed to do any speculation. And when we refer to speculation, there could be multiple things like shorting. There could be things like investing in futures and options. There could be things like day trading. So some of these are not allowed under the RBI guideline, and hence some of the platforms may not allow you to do it. But having said that, US markets itself, can you day trade? The question is absolutely.
Okay, so there are some issues, regulatory issues, which need to be addressed and followed as well. Also, there's been a lot of talk in the recent weeks about, the trillion-dollar companies that have come to fruition in the US. The Amazons, the Apple, Microsoft. Oh my God, that stock has been rocking lately. These are very big companies. At the same time, if you notice, even some of those smaller companies, and we all, as we speak on Zoom, the stock has been a rock star in the, at least in 2020, since IPO as well. Give us an idea of how investors should go about choosing some of these large and maybe some smaller, because in your portfolio, you want both kinds of stocks.
Absolutely. So, like you said, I think a lot of people think that now that some of these companies, like you mentioned, Amazon, have hit the $1 trillion club, have I missed the bus, so to speak, is one question that is typically there in the investor's mind. For that, you have to understand that businesses like Amazon have multiple revenue streams, and some of them are just getting started in some of the verticals that they're beginning with. So Amazon, as an example, has been in the e-commerce vertical to start with. The web services vertical came about slightly later, and then there are multiple other business verticals that the company is getting into. So finally, the value comes from each one of these business verticals. So in terms of the $1 trillion opportunities that you talk about, there are plenty of these out there in the US markets, and it is for an individual investor to identify some of these opportunities, because these businesses are also getting into new spaces and sometimes completely unrelated with their existing. While we as investors may think unrelated, they may still have a business theme around all of these new verticals that they're getting into. So it's very important to understand, as an approach, if I were to take it, it's very important to understand what are the value generating activities that a company is doing, and do I believe in that theory? Which means that you take a fundamental driven approach. You see what are the decisions the management is making in terms of getting into these business verticals. What is in it as an investor, as a shareholder for me? How will they monetize these opportunities? Basis this, you try to understand the value of the company today. Let's say, even if it's at $1 trillion, how will it go to, let's say, $5 trillion in the next, 5 trillion is a fairly famous word in India, but how will it go to $5 trillion, let's say, in the 5 years, right? So those are some of the things to evaluate. And like you mentioned, there are much smaller opportunities as well. Zoom, for example, these are all very opportunistic plays. 4 months back, I mean, no one was talking about a theme of work from home stocks and things like that, right? I mean, if someone was, they would have been a real, what do you call that, fortune teller, I would say. No one knew how, no one knew how the world was going to shape up in the last 3 to 4 months. But here we are. These are some of the opportunistic plays, and that's always going to be there. You will always have these short-term, mid-term opportunities that I always refer to them as, saying that, the work from home theme and things like that, they will always play out in the mid-term to short-term. You will always have to look out for the longer-term opportunities as well, on where, whether you want to go through dividend income or realize a capital gain. How do you stay invested for 3, 5, 10?
Some people may also have this question, given the way things happen in India, how safe are these? So if the investments are largely in fairly decent companies, is there any reason to worry if somebody is investing in the US markets?
So, right, there is always...
I may just add, because this question has come from quite a few people, so I'm not taking names. So there are quite a few people who've been asking this.
Absolutely. And I think that's a very valid point, right? Whenever you're dealing with an unknown entity, you always do a risk evaluation first, and you examine some worst case scenarios and understand what's going to happen, what sort of a security you have. So if you look at it that way, that is where I feel that more mature markets like US have a very fundamental and solid platform. Maybe it's because they've gone through a lot of bad experiences, but they have a very fundamental and solid platform that they offer for investor protection in terms of the governance of the companies, in terms of reporting structure of the companies. So, as an example, right, any Indian investor today who opens an investment account in the US market, on day zero, he's provided with a $500,000 account insurance. And this insurance is provided by the US government. So, it's backed by the US government. So, as a retail investor, you don't have to worry too much about what happens if something happens to my broker, for example, right? Like a Carby like incident happens in the US. What happens? Because at least in India, these are familiar brand names that we've been hearing, but a lot of new brand names when you deal with them. So there are structures in place which, you know, take care of the interests of retail investors. Again, it goes back to saying that there is very heavy retail participation in US markets, and hence these structures have been put in place. So there are a lot of structures that the government has put in terms of account insurance. There are a lot of reporting norms where I think sort of unpopular example, so to speak, in recent days were the Luckin Coffee, where, you know, at least you're able to identify some of these mismatches in reporting norm fairly early and not let it affect an investor, so to speak. So these norms being in place in terms of insider trading reporting, for example, in SEC is very strict about insider trading reports, and, you know, the entire management, if you look at it, of any listed company, almost in real time, SEC will tell you what sort of positions they hold, what sort of updates are there to their positions. So very strong governance norms through which these capital markets operate in the US. And hence, to me, that is more important, the structures being in place, the insurance process being in place, all of that. There will always be these one-off cases, you know, of edge cases that are there. But as long as you have these structures, processes, insurance, and mechanisms in place, as a retail investor, it is a very secure environment, so to speak, to invest.
It's very good that you've raised this issue of regulation and the regulator as well. For the average investor, Kumar, people who are investing, what are the roles of the two regulators here? I mean, does SEBI have any kind of a role? Some people may want to know this as well. And of course, since we're investing in the US markets, I would imagine that the SEC's role would be primary.
Right. So, as an Indian investor, SEBI always tries to protect your interests, which means that, you know, anyone trying to offer you any sort of an advice on what to invest in and all that, that is regulated by SEBI. But your actions itself as an individual investors are not regulated by SEBI. The same thing with SEC in the US side. You obviously have to deal with a broker dealer who's registered with SEC on the US side. So SEC is the one governing, it's the Securities and Exchange Commission, the equivalent of SEBI in India. That's the organization that governs all capital market activities in the US, and they regulate all the broker dealers, the custodians that are there. The custodians are equivalent of the depository participants. So, that is entirely regulated by SEC. So, as a retail investor, make sure that you're getting advice from a SEBI regulated entity. And on the counter side, whenever you're dealing with someone in the US, make sure you're dealing with a SEC registered entity. So these are the two things to be very careful about as a retailer.
You can you know, because there are quite a few questions also coming about the regulation part. Can you explain how the whole process will work stepwise, since if I as an investor start to invest in the US markets, if I start today, what all will happen over the next week or 10 days before I can start investing?
Right. So let me put it this way: it's as simple as investing in India. I'll reiterate that, and it's more of the fear of unknown that people say: is it complex? What can go wrong? It's as simple as investing in India. There are basically three steps. You deal with the SEC registered broker dealer in the US. You set up your account with them. Most of them have gone digital. Otherwise, there are enough digital platforms available in India, like Stockal. So you engage with one of these platforms. Within 24 hours, your account is set up. That's the first step. The second step is getting the funds from your Indian account to the US account. That, like I said, typically takes 2 to 3 days. There are a lot of banks who are digitizing the process. That will shorten the cycle as well. That's basically the second step. The third step is you pick and choose the companies or the portfolios you want to invest in and start your investment journey. And most of these platforms, again, like I said, have gone digital. So it's a very simple 3-step process that I spoke about. Of course, I am talking about a very happy flow here, which will happen, I would say, 90-95% of the time. There will always be a use case which falls into the 2 to 5% bracket, where depending on your individual circumstances, you may have to go through 1 or 2 extra steps in the process.
Mm-hmm. And also for people who want to regularly follow what is happening with a whole variety of companies, which they may want to track, they may or may not have investments. How do they track those investments? Because there are a few questions I'm seeing. For example, Arun Khanna says that, how will you help us identify stocks other than the obvious ones like Amazon, Alphabet, AMD, Apple, or some others?
Absolutely. So you have to rely on experts over there, so to speak. These are people, like I said, US markets have a very strong history. There are people who have been tracking these markets. There are people who have figured out various performance metrics in this market. So you have to take the assistance of experts till you get to a stage where you're comfortable with opportunity. And that is where I believe there are two things. One is on the individual stock picks, understand who are the analysts who are tracking it, go by some of the
Mm-hmm.
ratings that the analysts
Mm-hmm.
provide. Of course, you need to have your own investment theory at the end of the day. And we all as
Mm-hmm.
investors love to see our investment theory play out so we can pat ourselves on the back and say, I picked that opportunity very early. So you need to have an investment theory going in, but you have to rely on a lot of expert information, which a lot of these digital platforms again provide, whether it is analyst ratings, analyst reports, analyst opinions.
Mm-hmm.
Follow that diligently. Do your diligence before investing. This is for individual stocks. Now, if you take a portfolio approach to it, I would say rely on fund managers, rely on financial advisors. Again, deal with SEC registered entities, rely on the experience of these fund managers, understand thoroughly their methodology before investing. Performance is one thing. One can lure you in with a great short-term performance track record, but if you don't believe in the fundamental methodology that they're following to invest in, you should never invest in that. So understand clearly what methodology the fund manager is following, what the financial advisor is following. If you're comfortable with that, go with that. That's the best approach.
Mm-hmm. Also, there's a question from Anish Kumar who says that, could you please show us or share your experience how Dow has performed or fared in the last 10 years compared to a Nifty 50? Now, offhand, I remember some numbers for the Nifty because I used to track it pretty closely. The 2008 low for Nifty was 2,200. I still remember the date, 22nd October. Uh, Sensex closed just above 8,000 on that day. But the performance for Dow, you are the expert.
Yeah. So I'll tell you Dow. So there are three indices that people typically track in the US, just like you have Sensex and Nifty 50 here. There is the Dow 30. Now the Dow 30, largely, if you look at it, it's also constituted of some of the more traditional businesses, so to speak, like oil and gas exploration and some of these
Mm.
large. The second index is the S&P 500, which is way more broad based. The third index is the Nasdaq 100, which is more skewed towards technology companies. So depending on what sort of an investment you want to make, that is the right comparison to make, so to speak. So picking Dow 30 and Nifty 50 and trying to compare them may not be the right thing depending on context. It may be the right thing depending on context. So first is very important to understand what context are you comparing them. In terms of performance, I typically go back and look at these numbers only when I need to. So the two indices I follow very closely are the Sensex and S&P 500 on either side. And some of the metrics I remember, like for example, last 5 years, last 3 years, I was just looking at them a couple of days back. S&P 500 has outperformed the Sensex. Again, it is at an index level, right? So very hard to comment on underlying companies, but at an index level, S&P 500 has outperformed the Sensex across the time. I picked 7 or 8 time horizons. There was a 3 month, 6 month, 1 year, 3 year, 5 year, 7 year. Across all these 7 or 8 time horizons that I picked, the S&P 500 had beat it very easily. And this is all publicly available information. And I think in most cases, the growth rate was close to double. The second thing to understand is you have to build a portfolio for diversification, which means that, let's say, you're investing into highly correlated assets, then it's not very good for your diversification, right? You have to ideally invest in assets which are not highly correlated to build a very diversified portfolio. The third thing is the currency angles that comes in when you compare Indian versus global markets, right? Again, I spoke about goal-based planning and things like that, right? Eventually, if you want to build a dollar-denominated portfolio, you have to also look at currency gains. So, for example, 5 years back, the USD INR exchange rate was at roughly about 62, if I remember correctly, and as of yesterday, it was at about 75. So someone who has invested $100 in India versus invested $100 in the US has not just gained because of the index going up, but has also gained because of the currency, Indian rupee depreciating and the US dollar appreciating. So you would have easily gained 2 to 3 percentage points just because of the currency appreciation that you saw on an
Also,
annualized basis.
so there's some questions also about the investing in the index funds and some of the other funds, not just specific stocks.
Right.
The question is, how does one approach that?
Right. So I think, and I keep repeating this theme very often, right? It's one of my favorites, so bear with me, that US markets are built for very good retail investor participation. And that is the reason you see something called as ETFs, which was exchange traded funds as a concept, become extremely popular in the US. Let me take a very simple example. S&P 500 has 500 stocks. So let us say that I believe in the market growth story. I don't know how to pick individual stocks. What do I do now? I have to go and invest in individual 500 companies in the same proportion that they constitute S&P. The ETF solves that problem for me. I go and invest in one ETF that is there. Those are essentially the exchange traded funds that we are talking about. There are very popular, a lot of exchange traded funds in the US which mimic equity indices, which mimic various other underlying assets, which are very simple for a retail investor to go and invest in. One of my favorites from a trading background, again, I'm not vouching for anything, but one of my favorites from a trading background is there was a S&P 500, there is still an S&P 500 ETF called SPY, which is offered by the State Street Global Advisors. That is the most liquid ETF in the entire world. I think they have like a $300 billion asset under management, and daily churn is at roughly about $2 billion. So huge liquidity, very easy for an investor to get in, get out, unlike a mutual fund. And that's why a lot of capital of individual investors is shifted away from mutual funds to these ETFs. Because you can trade the ETF like a stock. You can get in right now, you can get out 5 minutes later. You can't do that with a mutual fund. The mutual fund where the fund manager decides to invest and all of that is a black box for you. Whereas with the ETF, it's very clear. Minute to minute, it's tracking an index. If you believe in that index, you invest in it. So that is where these exchange traded funds are extremely handy. I'm glad someone asked about it. They're great instruments, and there are plenty of such instruments available in the US markets to invest.
Okay, no regulatory challenges of investing in ETFs for Indians because, as you mentioned, this is just for clarity. You mentioned that speculative activity RBI has a problem with, and the regulations don't permit. Is there no such bar on ETFs?
No, there is no such bar. ETF is not considered a speculative instrument because it is just, like I said, it's a structured instrument that tracks very closely an underlying asset. So no bar on trade.
Okay, okay. So let me also look at some more questions that may be coming in because quite a few questions. And of course, can we also invest in IPOs is the question. Just before, so we just had the Warner Music IPO, valued at 15 billions now, $15 billion now. Very interesting time because the revenue for music industry is now beginning to grow again. What about people who want to invest in such IPOs?
Absolutely. Indian investors are allowed to invest in IPOs. A lot of the digital platforms that I spoke about, a lot of the digital platforms that I spoke about allow Indian individuals to invest in IPOs. So IPOs are definitely on.
Okay, IPOs are people. If you could also explain how a good way to go about researching and making sure you identify the right approach or right way to go about investing. If you could tell that, because it'll benefit everyone who's listening here.
Sure, let me take a shot at it. I would say the beauty of it is everyone should have a unique approach on how they go about investing depending on their goals. But I can share some of my experiences in terms of the way one would think about investing. First, like I said, you have to believe in the theory. Minus the numbers, first you have to believe in the theory. So if you believe in, let's say, an Amazon, which means that independent of the numbers that they've been able to post, you have to believe in the management, you have to believe in the businesses that they're investing in. So you need to have a fundamentally strong theory. You need to believe in the governance norms that they have out there. So that story should be your platform. That should be very clear. Minus that, irrespective of the numbers, you shouldn't be investing in any of these stocks. Once you believe, you've identified a list of companies where you believe in the story, that is when you start evaluating numbers. You start looking at the financials yourself if you are a trained financial professional in terms of the income statement, balance sheet, cash flow statements. If you're not trained yourself, there is plenty of help out there. There are more than enough registered certified financial advisors, financial planners who will give you, an assessment of the financial numbers that they're looking at and how they interpret it. Go by that and try to understand why someone is saying what they're saying. So that will give you a very clear picture on numbers. So, and the growth story has to tie in with these numbers. And hence, there goes saying that now I believe in the fundamental story. There, now I believe in the numbers and I'm ready to invest in these stocks. That would be my approach for stock picking. The second approach that typically goes towards portfolio investment is to understand what asset class you want to invest in, where you are in terms of risk profile, what are your goals, why are you investing. Once you're very clear about that, you will also be very clear about what sort of asset classes you want to invest in, and the huge spectrum of asset classes, right? Starting from government bonds on the one end of the spectrum, all the way to, let me say, bitcoins on the other end of the spectrum, which are highly volatile, right? So you have to pick and choose what percentage of your portfolio you want to invest in each of these asset classes. Equity, definitely there will be an asset class that most people will be interested in investing. And within equity, you follow this approach of stock picking, you follow the approach of portfolio building within equities, which means you invest across sectors in equities, you invest across themes in equities. And that's how you go about as an approach, how do you build a
Okay. Okay. There's also a question from Shankar Devanarayanan. And he has, his question says that, oops, 1 second. I'll just see, I may have made. So he wants to find out if the say, if what happens for people who are outside of India, because there are some, obviously, mm, Indians are regulated by the LRS scheme, as you explained. Some
Right.
people who are listening to us outside of India, how easy is it for them? And what are some of those unique challenges they have to face in going about with their investment in the US markets?
Okay. So I'll again, I think this is a very user specific question, but I'll draw the broad.
If I may just add, sorry to interrupt, Kumar. The question comes from Dubai, and the gentleman wanted to understand it for NRIs.
Sure.
This is Shankar
So
Devanarayanan.
got it, got it. So Indian residents are bound by LRS, which means they have the cap. For non-resident Indians, the RBI cap is not applicable. The tax norm will depend on the country where you are resident, what sort of an agreement. Like I said, India has a double tax avoidance agreement with the US. The tax norms will depend on the country that you're resident in right now. Those are the frameworks that will drive broadly. But in terms of LRS, the $250,000 annual limit is not applicable for non-resident.
Mm, mm, mm. Also, there are quite a few things that have been happening in the last 3 months or so. The markets are seeing, some very traditional businesses getting routed, completely getting decimated in the last few months. Uh, some people may be tempted to buy into those stocks, hoping for a revival. What is it the same way as it works in the Indian markets, or there are a few questions I can see as I was scrolling down.
Mm-hmm.
Is it the same way that it works in the Indian markets, where it might there might be challenges, or is the system more robust in the US markets that some of these businesses could be revived and they may not go into a Chapter 11 kind of a bankruptcy scenario?
Right. So, so like you said, I think there are all sorts of asset classes out there, whether it is the Indian market or the US market. There are large cap stocks, there are blue chip stocks, there are mid cap, small cap, there are penny stocks in the US market as well. And the risk profiling remains the same, whether it is in, that's why I'm saying if you're invested in the Indian market, the same principles apply in the US market. It's no different. It's very simple as an investor to, translate all your learnings into the US market. So penny stocks exist. There is always a higher risk with penny stocks. There is always a slightly higher risk with small cap stocks, lower mid-sized risk with mid cap stocks, lower risk with large cap stocks. That's always going to be there. And traditionally, the thinking is that the blue chip and large cap stocks have enough cash in their pockets to be able to survive some of these dips, and hence they will be able to ride the storm better than some of the mid-size and smaller size. But at the same time, some of the mid-size and smaller size also turn into opportunities when these storms hit, because they've sort of pivoted their business or gone on to a different business model that helps them, leverage on the opportunity, so to speak. Like I spoke about work from home stocks, which have become very popular in the last 3 months. So there is always going to be a mix of all of these. And as an investor, you need to be on the lookout. You need to have a good portfolio that will give you great returns and which will reduce your risk. So you will have a basket of mid cap, small cap, large cap, all sorts of stuff.
There's a question from M. Kumar, and there's a very basic question, but I did want to take it so that there is more clarity in people's minds. M. Kumar asks, what is the difference between a NASDAQ, S&P, and Dow Jones?
So, famous exchanges in the US. There is a New York Stock Exchange, NYSE, and there is NASDAQ, which is another exchange. There are multiple other small regional stock exchanges in the US, just like in India. For example, I'm sure you guys haven't even heard there is a Bangalore Stock Exchange, there is a Chennai Stock Exchange, just like there is a Bombay Stock Exchange. They're all lesser known stock exchanges. So similarly, in the US, there is a network of these regional stock exchanges that exist. The National Stock Exchange is the equivalent of NYSE and NASDAQ. NYSE has more of the traditional businesses going to NYSE, and NASDAQ has more of the tech companies listed on NASDAQ. Again, the exchanges are all private limited companies, so they're all for-profit companies, even in the US. And some of these exchanges itself are listed. So, they're all, they all have a business model and all of that. And then there are indices that people track. Just like you have the Sensex and the Nifty 50 here, there are three broad indices that the US investor tracks. Those are the Dow 30, which is the more traditional index that one used to track, the S&P 500. So S&P stands for Standard & Poor's. It is the largest credit rating agency in the world, and they have a bunch of other businesses. One of them is creating such market indices. And in fact, the Sensex is also now called the S&P PSE Sensex. So it is owned by the S&P, the Sensex index that got created. And then the third index is the NASDAQ 100 that I spoke about. So there is a difference between the exchange. The exchange is where the stocks get traded, and the indices. The indices are just what I call as a basket of stocks, which is ease of just for convenience of the investor, right? Like if I ask today a very broad question saying, how is the US market doing? I can't go and look up Google, Facebook, Amazon and 500 such stocks and then comment on, which is up, which is down, who's doing what. So the index is a very logical grouping of this, saying that if the S&P 500 is up, that means looks like overall the market is doing well. So the index is a logical grouping of stocks, the exchange itself. So NASDAQ is an exchange, the NASDAQ 100 is an index, S&P 500 is an index that constitutes stocks across multiple exchanges. The Dow 30 is also an index.
Also, if since we are on that theme, just one more question on that. Shweta asks this question: what is the difference between an ETF and FOF, the fund of funds? And she's asking the context of the Indian scenario.
So an ETF is essentially listed on an exchange, which means you have to understand that it is as simple to buy and sell an ETF as it is as a stock. So all the benefits of trading in a stock come with ETF. Whereas a fund of funds, typically, my understanding, whether you talk about it in the case of private equity funds or any higher level funds or even mutual funds, right? They're all private instruments, which means that they're not listed on an index, which means that there is no ready-made order book, there is no ready-made buyer and seller list that is available. That's the one huge difference. And the idea behind ETFs is to package these indices or any other underlying instrument in a way where it's very easy for a retail investor to invest. Whereas fund of funds will have multiple other constraints, right? For example, there will be a minimum amount you have to invest. There will be entry barriers, exit barriers, things like that. Whereas in an ETF, it's just like a stock that's in, if I have $100 in my pocket and I can go and buy an ETF on the exchange. It's as simple as that.
That's very important as well, because the liquidity part that you spoke. Some people also messaging that they missed some small part of the conversations. So we hope some of those questions can be taken again, but it's very difficult given the time that we have. And as I see, we are running out of time. Okay,
so
there's another. Yeah,
if
please.
anyone who has questions can feel free to write into us. You can visit us at www.stockal.com. We have an email address and a phone number there. Please feel free to write into us. We're like I said, from an Indian standpoint, we are all in the beginning of what I believe is a global investing journey. So we're all educating ourselves. And this is one such initiative that Ashutosh has set up, which is very nice in terms of educating the audience. So we'll go through multiple such initiatives, but obviously there is only so much that we can cover in a single webinar. So feel free to write to us. Any questions that you have, we'll be more than happy to answer them. I understand we can't take all the questions in a 1 hour window. And I think the email ID is support@stockal.com. Please feel free to write to them.
Okay, so we'll try and take 1 or 2 more questions before we seek permission to wind up. There's a question from, okay, the person doesn't have a name, only has a numeric ID. Mr. Kumar, could you please explain what you said initially about some protection or insurance cover of 50 million for those who open an account? Okay, talking, I guess this is about the protection given to retail investors.
Right. So like I mentioned, it's an insurance scheme. I heard 50 million mentioned. It is not 50 million. It is $500,000. That is $500,000 is the insurance amount that is provided by the US government to every retail investor in the US. So as long as you're dealing with the SEC registered broker dealer in the US government is backing your account.
Okay, and there are also some questions about very specific stocks. I guess we can't go into stocks, but if you could get to the broader themes, maybe in the last 5 or 10 years, how have some of these themes played out? You know, in the beginning of the decade, we had the tech stocks taking off. Today, we have some of those space stocks being listed. Space tourism is taking off. Right. So if you could talk a little bit about the themes that play out in the US markets.
Yeah. So there are some fundamental themes that are always going to be strong, I believe, in the US market for multiple reasons. I think technology is going to be a very strong theme. Just looking at the innovation ecosystem in the US market, just the way innovation gets funded, whether it is public funding, whether it is private funding through venture capital funds and all that, right? Just the environment out there supports so much of technology driven innovation that's going to be a very strong theme. And technology applied to multiple domains. So when I say technology, it is not to be construed as just a software company, so to speak, but technology applied to the healthcare domain, technology applied to even space domain, right? So technology driven innovation, I still believe US has been the hotbed, will continue to be the hotbed because they've got the fundamentals right there. They have a very strong ecosystem, whether it is in terms of funding, whether it is in terms of education, they're at the cutting edge out there, right? They provide a very good environment out there. So that's going to be a very strong theme. The consumer driven story, I believe, is going to come out of Asia. So any markets which are still, any companies which are still listed in the US but are catering to an Asian market consumer driven story, that's going to be a very interesting theme playing out in the next 5 to 10 years. It has played out already to some extent, I would say, in the last 5 to 7 years, but there's a huge way to go. I mean, Asia as a consumer driven market remains very, very untapped today. And that's a huge story that I believe will play out. In terms of the other big theme, we saw solar emerge as a theme, which was, I thought, a very linear version of what we call as the environment, sustainability, and growth theme, so to speak. So environmental and sustainability are going to be huge themes going forward, whether it's water technology, whether it is power technology, some of these emerging technology companies that are there. That's a very strong theme that's playing out in the US. Again, very early days, a lot of innovation happening there. Some listed companies are there as well in the same theme. So keep your ears and eyes open out for some of these interesting themes.
Okay, we have run out of time. 1 hour is what we asked for people to for this important educational initiative. So thank you so much, Kumar, for joining us, taking the time to explain some of those things in such a lucid way, such a simple way, so that people can understand, and hopefully we can bring more such initiatives and more such education for the investors, people who want to invest in the US markets. Thank you. For those of you who are listening to us, thank you so much for joining us. I'd like to personally take time point out, thank the team at Stockal and its partners who have helped us bring this webinar to you. We hope, as I said, to bring in more such in the educational series. As we'd also said a little while ago, if you need to reach out to us, reach out to the team, please feel free to write at this email address that you have on the screen. That's support@stockal.com. Some of those questions may have been unanswered, so the team at Stockal will get back to you. Any questions you'd have, any clarifications you'd want to seek, that's where you can go, and that's where you can write to. And of course, there'll also be some, a small request from Stockal for anything that you'd want to know from similar webinars in the future. So if you could share your views there as well. Thank you so much for being with us. Thank you, Kumar, again. And thanks to this team at Stockal and its partners.
Thanks, everyone. And thanks, Ashutosh, in specific, for hosting this. Thank you. Bye.
Thank you. Bye.